Most traders obsess over the 0.618 and 1.618 Fibonacci levels, but one of the cleanest reaction zones in futures trading is the 0.79 extension. It's a level a lot of traders ignore, yet often where price gives the best opportunity for entering on reversals, continuations, and high probability entries. If you trade the S&P or Nasdaq or any futures market, understanding this level can be a serious improvement to your precision. Hello people. In this video, I'm going to explain why the 0.79 Fibonacci extension is one of the most important levels that I use when I'm trading futures, especially for entries, pullbacks, or anything along those lines, even continuation confluences. It's not magic or some secret indicator. It's simply understanding where liquidity sits and where traders get trapped, and where institutions quite often step in. And once you start using this and applying it, you will notice it everywhere when you're trading. First things first, I hear you asking, what is the 0.79 extension? I'll be honest, I'll keep it simple. I feel like a lot of traders get trapped with different levels, the 0.382, the 0.5, the 0.618, even sometimes things as random as the 0.786. I can hear you thinking to yourself, 0.786, 0.79, much of a muchness? No. I'm going to explain why. Because when we're talking about the 0.79 extension, we're looking at a very specific zone where price pushes past the standard retracement and taps into what's called a decision zone. This is where areas where weak traders get shaken out, late buyers get trapped so their orders don't move or stop them out, even worse. Strong hands take control to move them out of this area, which usually causes a big reaction from being tapped into this zone in general. What we're looking at in front of us is almost a pitch. Obviously, it's very late in the session. I'm in the UK and it's just gone 8 o'clock. So, I mean, I would be expecting us to go from here. If I was trading at this time, my entry would have been up here. The magnet's on, so it's not doing me any favors, and I'd be targeting liquidity down here. But obviously, being so late in the session, I wouldn't enter anything at this time. But it is a good example of the setup and why the setup's important and helps you trade with high probability. Yeah, where do we go from here? The level is very deep, and it is deep enough to create fear in the markets, which is often what causes the markets to move. I hear you asking, why does this matter for futures, Nasdaq and S&P specifically? The futures market is driven by liquidity. The price doesn't move randomly. It moves to areas where orders already exist. So you can use that to kind of dictate as to why this level is so important and why it does what it does. The 0.79 extension often lines up with exactly that: stop losses, liquidity grabs, and engineered pullback. So let's say, for example, Nasdaq's in a bullish trend. Price breaks higher, everyone gets excited, and then we get a pullback. Most traders expect support at the 0.618 level, which is slightly below the 0.79. I don't need to explain basic numbers to you. You can use this, you can use what you're seeing on your screen as a basic prerogative to where 0.618 would be, which would be slightly under here. And as you can see, if you had entered in off the 0.618 and you're trading how I do with very tight stop losses, very little margin for error, you would have been tapped out. And then probably got angry, entered again, and your account's gone. Besides the point. But what happens once we'd got to the 0.618 level? We kept bull running all the way up, even past the 0.79 level, but we did only just wick there on an hourly basis. So obviously if I pull that down into the 1 minute, you can see we went about 20 points above it, which is fine because we did, if you've watched my previous video, we did have a rejection block above there. So that should have been our entry anyway, which you could have entered with more or less no drawdown. Look, and I'm not going to sit here and preach to you like this is the only compliments you need to chase 1 to 10s, 1 to 15s, even 1 to 5s, risk to reward trades. But it does give you a sense of direction of where and how you should be trading. What obviously we've run past the 0.79, taps right into the rejection block and then push straight back down. So you can see here, if you understand how markets work, that people's been stopped out, people have panicked and then shot the price down in the other direction. I'm sure this will come to fruition, but it'll probably be over Asia session, and I'm not in the trade anyway, so it doesn't really make a whole lot of difference to me. Let's just put that back. But what I'm trying to say is this isn't an accident. This occurs on many time frames. Obviously, that like same with the rejection block videos. The higher time frame, the higher power it holds, but obviously the longer it will take to play out. So do bear that in mind when you are trading these. And it's not 100% fault proof. Obviously, sometimes it does go past this. We continue with the bull run upwards or push downwards, and it will knock you out despite the fact that you've got rejection blocks or SMTs or fair value gaps or whatever other complements you are using to trade it. But more importantly, how do you use it? You use the 0.79 extension as a confirmation zone, not just as a blind entry, and I can't stress that enough. You're not just placing limit orders on the 0.79 because, like you say, for this trade to have even gone remotely in your direction on one lot of NASDAQ, you would have been looking at where did we go up to? $500 in drawdown, which is, no one wants to be in that situation, let's be honest now. When you could much simply wait until the rejection block above got tapped into. So if we stick that there instead, granted you would have seen no drawdown, but you could have had a lot tighter margins when you was trading, because obviously when the market was here, you didn't know it was going to stop right on the CE of the rejection block, did you? Because obviously I know that number is smaller, but theoretically if you was on the 0.79, you was technically risking double if you was still using the rejection block as an entry. I hope that makes sense and it's not just verbal diarrhea, but if there is anything else you'd like to ask, please just let me know. But if I can give you an example, you want compliments as well. So just like we're looking at here, and this is obviously at the time of recording, it's 8:28 where I am at the moment, and if I go down onto the 1 minute, it's just turned 8:29. But yeah, you can see this is all happening live. I'm sorry if I can get my words out. It's all happening as I'm explaining this to you. Just a bit of a preference. I do apologize if you can hear my cats going mental in the background. They found a cardboard box and there's just no stopping them. But yeah. For example, the price hits 0.79 and aligns with previous structure. You also see a displacement and you get a rejection block from the previous hourly candle or rejection as a strong candle response. That becomes a high quality setup, which obviously we're looking to chase all the time. We want high quality setups because that's what gets us paid. It works especially well, at least that I found it works especially well on New York session open, London session open, Asia session open. I tend to focus on London and Asia more, only for the pure fact that there's just not as much manipulation. Yeah, that's me personally. It does work in all of them. But there are a few things I want to point out, and because I don't want you lot doing it, be like, oh, Bluefert told me that the 0.79 was the golden level, and I've entered 5 different trades in the last hour and lost all of them because of him. Firstly, not financial advice, that's your problem. And secondly, I'm prefacing this so this is evidence of the fact that it is your problem. The biggest mistake that people make when they're using this is they try and force it on every single swing high and every single swing low. Not every move deserves a Fibonacci retrace at all. You need a very clean structure for this to work. Clear impulse and obvious swing points. If you're drawing a Fibonacci on messy price action, you'll get messy results. Another mistake, treating this level like it's a guaranteed support or resistance to your trade. It's not where you look for evidence, and it's not blind faith. Trading is all about probability, not prediction. So you don't want to guess where the market's going. You want to do everything to work with the market as it's going there. Realistically, a lot of this falls down to your psychology. This level also helps with your psychology, because instead of you chasing the breakout that's already happened, it forces you to become patient, which is worth its weight in gold when you're trading. You stop buying at the top of trends, and you let price come to you. Same in the other direction, you stop buying at the bottom, and you start trading where risk is tight and reward is asymmetric. That's the real edge, not the Fibonacci itself, but the discipline that it creates. So if you trade futures and have been relying on various different levels, or Lord forbid, just support and resistance, start paying attention to the 0.79. Watch how price reacts to there, backtest it, journal it, and build data around it, because the goal isn't to find magic, it's to find repeatable behavior. And for me, the 0.79 extension is one of those repeatable behaviors. If this helped, let me know. Put a comment in the comment section, and yeah, if there's anything that's unclear, please also let me know where I could go better. I'm new to this as well, so let me know what helps you best, and I will try and deliver that. If you want me to break it down on a live setup, more than welcome to. Let me know. And if you're serious about your execution, please subscribe, because that's what this channel is about: precision, process, and trading like a professional.